I published a new blog post yesterday, February 11th, discussing some of my trades over the past few days. A link to my blog post can be found in my profile section here at YouTube. For those who have been reading my blog, which started in October 2008, they will already know that I am an active trader. The allocation shift discussed in this last blog was to reduce my common stock allocation some and invest in alternative yield assets, including the purchase of 40 treasury bills at auctions, 6 investment grade corporate bonds, and exchange traded first mortgage bond, and other alternatives for income other than common stocks. I was far more comfortable buying stocks in March 2009 than I am now. I view the U.S. stock market as excessively overvalued, though there are pockets of stocks that are arguably priced in what I would characterize as a reasonable valuation range. With the Shiller PE ratio crossing over 40, my comfort level with stock investments is probably non-existent now. Taking into account my age and financial condition, the dot-com bubble high in the Shiller PE was close to 44 in April 2000 and was at 31 just prior to the October 1929 crash. A long-term chart of this Shiller PE ratio can be found at the MULTPL website, which you can find by simply searching for Shiller PE ratio. That's SCHILLER. I have stated in the past many times that the Shiller PE is not a market timing indicator. Stocks can continue to rise even when that ratio is near an all-time high as now. From my viewpoint, as that ratio rises from an elevated level to an extremely high ratio as now, the danger for a massive valuation reset in the stock market increases, and the likely returns, even without a massive valuation reset, are likely to be low for several years, particularly if earnings growth slows for whatever reason. And at my age, and given the time that I have left to recover from a massive valuation reset, the danger for me is the first issue, which is that there will be a non-temporary massive decline in stocks. Over the past several months, I have noted here and in my blog post that the U.S. job market was weak. The BLS reported yesterday its annual 2025 revisions to the previously reported monthly reports. With the revisions, the U.S. economy added 181,000 jobs last year. That is an incredibly weak job market. I have a snapshot of the revisions in my last post. One long negative trend for jobs, which will result in massive job losses, will be AI eliminating mostly white-collar jobs, and this is already occurring in significant numbers in the financial industry. This trend is only starting. It will gain steam as AI becomes even more sophisticated. I have some references in my post, including an article about workforce reductions at Citigroup. Estimates of job losses in the U.S. resulting from implementation of AI products range from 5% to 20% of the workforce. This trend will accelerate and unfold over the next decade as AI products become more sophisticated, and they're becoming more sophisticated rapidly now. Lowering interest rates will have no impact on job losses caused by these AI products. And the job losses and the weak job market has really nothing to do, in my opinion, with the currently low interest rates. and lowering them further will not cure the problems that now exist for the job market, which include Trump's policies, including the tariffs. There will be relatively low-paying job openings occurring in agricultural, food processing, construction, hospitality, and fast food restaurants due to the mass deportations of immigrants, but there is no indication in the job data that I can find that U.S. citizens are rushing to fill those openings, which are only starting to open as the mass deportations are still in their early stages. This could also result in supply chain disruption for several products and place increasing upward pressure on prices. The job report for January, which is subject to later revision, was celebrated as a good one with an initial estimate of 130,000 jobs created. That is a weak number for the U.S. jobs market. It is not a good number. The prior 2 months were revised down, and downward revisions in the prior 2 months with each job report has been the norm for several months now. That is the trend. Most of the jobs created were in recession-resistant sectors, with 82,000 in healthcare and 42,000 in what the BLS calls social assistance. Many of those jobs are low paying. In my last post, I discussed some risk mitigation techniques that I use for common stocks. The main risk mitigation strategy is simply to keep my stock allocation at less than 10% of total assets in my brokerage account, and then I spread those positions over 200 to 250 stocks. I will engage in a lot of trading to implement the risk mitigation strategies that I now employ. I discussed one in my and a comment to my last blog post. I started a position in UDR, an apartment REIT, large apartment REIT, in my Schwab account, and started to average down in small lots after my initial purchase. The apartment REIT sector has been weak over the past year or so. So averaging down after an initial purchase is something that I half expected to do and did do. As the price went down a little bit further, I started 2 duplicate positions in UDR in my Schwab account and in my Fidelity account and in my Vanguard account at lower prices than I had started in my Schwab account. I eliminated profitably those 2 duplicate positions in my Vanguard and Fidelity accounts yesterday, did so profitably, and will have snapshots in my next blog post. Investors reacted positively to UDR's 2025 fourth quarter report, and I had less enthusiasm than they did for that report, which led me to eliminate both duplicate positions, which is another risk mitigation strategy. I now own 62 UDR shares in my Schwab account, and I just turned off dividend reinvestment, another risk mitigation strategy, since I view the price as unattractive or the purchases would increase my average cost per share, which are the 2 reasons why I will turn off a dividend reinvestment as a risk mitigation strategy. And then I will frequently use specific identification, a cost method to sell the shares purchased with dividends at a profit. I view UDR is an acceptable long-term hold for me, so I will likely continue to buy shares in my Schwab account when the purchase will reduce my average cost per share. The risk mitigation techniques that I use are really, as I as I emphasized in my last video, are unique and tailored for my risk profile, which includes my age, the time I have to recover from any massive stock market losses. And I've gone through three periods where there was a 50% stock market decline in my investing career. So I know that they can happen, and I don't want them to happen with me owning a lot of stocks at my age.